Well, good afternoon, everyone, and welcome to Real Estate Roundtable. I'm excited to be here today with Michael Torres Ricci, and he is the Executive Vice President and a founding member of Ariel Property Advisors. Michael is going to tell us a little bit about himself as well as his company. And then today we're going to dive right into all things multifamily properties. That's what we're going to be discussing today. But the great thing about having Michael on today is that he has a wealth of knowledge when it comes to multifamily properties. He, as I said before, is a founding member of Ariel Property Advisors, and he's been doing this for the last 15 years. He'll give you some background about himself and his company, but we have a lot to learn. And we're gonna look back at the last decade. We're gonna take it back from 2009 to 2029. We're gonna look at pre-COVID, and then we're gonna look at a few predictions for the future. Granted, we don't have a crystal ball, so there's not a whole lot that we can do when it comes to like predicting the future, but he's gonna do his best. And so, Michael, how about kicking it off and telling us a little bit about yourself and your company, besides the fact that he has the most adorable little daughter. Like, she's only one, but she's a princess. She's adorable. Take it away, Michael.
Thank you so much, Kaylin. Hi, everyone. Mike Tortorici, Ariel Property Advisors. So we're a commercial real estate services firm focused on New York City, covering the 5 boroughs. I helped start it up a number of years ago, and we're kind of unique to the commercial real estate services firm in that we're structured like an investment bank. 3 separate divisions: investment sales, which is what I do, help owners buy and sell buildings all day long. Capital services, so if you know someone or you yourself are in the market to get debt on an acquisition or refinance, it's something our capital services team can help you out with. And our 3rd division, a real differentiator for us, is our research division. And we basically centralized, we established a centralized back-end team with analysts and other sales support that day in, day out, put together comparable sales reports, study all the trades that take place. They use that to put together market reports and valuations, free valuations for owners looking for some perspective on pricing for their property, and really give us the tools that we need as service providers to be informed resources for owners and market participants and people just looking for information. So anyone that's joining, if you ever, as a follow-up to this, could just use some information offline about what we're seeing trading, feel free to give me a call, or we've got a lot of free research on our website that covers the boroughs and covers the multifamily market specifically. So I'd encourage you to visit there and call us up and use us as a resource. So.
Thank you.
About our company.
Go ahead.
Yeah, about me. So as Kaylin said, I got started back in 2004, and at the time I joined a company that was around then called Massey Knakal, which some people may know. They were a leading building sales company here in the city. Eventually were purchased by Cushman & Wakefield, and there I met up with my 3 partners today, Shimon Shkuri, Vic Sozio, and Ivan Petrovic, and formed a very tight team. And we did a lot of multifamily sales there in Upper Manhattan and in the Bronx, and through those relationships started seeing multifamily sales throughout the city. Upper Manhattan and the Bronx have a lot of multifamily properties, a lot of multifamily buildings trade there compared to some other parts of the boroughs. So people that are active in multifamily tend to be playing around up there, and that led us to one day decide to go out and start up our own company with the structure that I just talked about. So we saw the boom from, call it 2002 up until about 2008. We went through the recession, the Great Recession that took a while to get out of, and then we saw this market, this expansion from, call it 2010, 2011, up until For the multifamily world, I would say really 2018. Mid 2019 is where things really started to go down as a result of the rent regulations that were enacted that we'll get into in a minute. And now we're in a situation with COVID that has really just kind of compounded a lot of the issues that were popping up in 2019. So I'm happy to take your questions or expound upon all that.
Great. Thank you. Just as a reminder to everyone who has joined the webinar, if you have questions, please type them in the Q&A and we'll do our best to answer them. But Michael, you started talking about, 2009, and we're going to go back to the last decade. And I want for you to talk to us about pricing and sales volume, in that 10-year span. Now we've entered a new decade, but let's think about 2009 to 2019. And a lot happened during 2009, and we had the recession, but let's talk about that. How were prices, how were sales in the last decade?
Sure. So I kind of break it up into three chunks, three separate periods for the decade. 2009 was the bottom in terms of sales volume, in terms of what traded. Between 2009 and 2012, most of the people that sold weren't really discretionary sellers. The prices weren't that great. So if they were selling, they usually were doing so for some kind of estate issue that they were solving. If they were covering debts in other projects that they had, and they had equity in their New York multifamily, they sold that. Distress sales took place, less so in Manhattan, because in many cases the loans that were out were conservative enough that the banks could hold on to them. The distress sales more or less took place, I'd say, in Upper Manhattan, the Bronx, parts of Brooklyn, parts of Queens. And really what we saw was, just from 2009 to call it 2012, just not a whole lot of activity. Cap rates really peaked in about 11, 12, in some areas of the city getting up to about 6% or so. And that was really kind of the early stage of the recovery, I'd call it, from 9 to 12, with pricing really bottoming out in 11 or 12. It took a number of years to bottom out. What then happened was, after 2012, there was really, at the end of 2012, I don't know if anyone here remembers, but there was the tax reform from the Obama administration in 2011 or so, and it changed the whole picture of capital gains, so that between the Obama healthcare plan and between some reforms on the tax side, capital gains were going up between 2012 and 2013. So we saw a real push at the end of 2012 of all kinds of sales transactions, as people tried to take advantage of the lower capital gains that were offered that year, that were then about to change in 2013. So there was a big push of sales, and then really the expansion, I would say, started to really take off in 13, 14, and we saw, I remember in the spring of 13, we were working on some things, and all of a sudden the interest really started picking up. The prices were going up faster than we thought that they would, and really we started seeing an acceleration in terms of pricing from 13 to, call it 15, maybe early 16. And it wasn't until that point, 15, 16, that the prices had recovered to what we were seeing pre-2009. The previous peak that we saw in 07, 08 in terms of real estate values on the multifamily side didn't recover to, call it 2015 or so. And in fact, I would say probably at that point started to hit some new highs in terms of pricing. And then really from 15, 16 on, things kind of plateaued in terms of pricing. We saw sales volume started to take a little bit of a dip. It really kind of plateaued in 16. In 17, things went down, I would say. And then we had a little bit of a bump in 18 in terms of things, but then things started to unravel in 19 with the coming of the rent reforms. So been a bit of a bumpy ride, but really three chunks, kind of a recovery, hitting bottom up until 2012 or so, an expansion to 15, 16, and then a plateauing and now kind of a downward trend brought on by the rent regulations and what we're seeing now really accelerate that with the virus.
Okay, let's go a little deeper into that. You just mentioned the rent regulation that pretty much affected just about everything in terms of real estate in New York, for a lot of landlords and, everyone. There's still a lot of litigation, pending litigation. We don't know when they'll be resolved, but everyone wasn't pretty happy. What can you say about the rent regulation? Can you tell us how that affected the multifamily area?
So people knew that change was coming in early 19, but they didn't know how much change, and they didn't know, the extent of what was going to happen. But in anticipation of that, we saw kind of a run up we saw, as I mentioned before, a little bit of a run up in sales in 18, and then not knowing what was on the other side of the regulation that was expected to come out in June, there was a rush of people that bought buildings in 18 and 17 to really get their business plans done and achieved, so that they didn't have the rules changed on them midway through investing. And we saw just the market slow as people didn't want to get caught out on a limb with things that they didn't anticipate. And I would say that going into June of that year, people expected, people were expecting free market to be finished. They expected deregulation to be squashed by that regulation. So that means that for those of you that aren't familiar with the New York rent laws, if you have an apartment that was under a certain rental level, it was roughly, call it 2,700, and there were rules that were in place so that if you got the legal rent through a whole bunch of improvement figures that you could do and other increases that they allowed here and there, but if you got that legal rent above 2,700, that unit would then be decontrolled, and in the future, not immediately, but in the future, you can charge whatever the market would bear. People thought that there would be a way for rents to go up, but if you got that to 2,700, that would probably be stabilized moving forward. And they expected the way that you could increase rents on the stabilized side to be watered down. What they didn't expect, and what threw everyone for a loop, literally the day after the rules were announced, because somehow no one leaked this and no one got out ahead of it. But what they did not expect was the way that they changed the laws were that they capped the amount that you could increase a rent stabilized apartment, regardless of its size, regardless of its location, to a relatively, what I would argue is a relatively low level, basically $83 or $86 a month, depending on how you do the math. I believe it's $86 a month. And the way that they did that was they said that you could you could invest about $15,000 into an apartment. You could only, through some mechanism, raise the monthly rent by X. And basically what that meant was that the amount that they could take a 3-bedroom apartment, for example, that was at $1,000 a month that became vacant, the only amount that they could increase that was $83 or $86. And even if the market could rent $2,000, $3,000, $4,000, there was no way in the near term, as long as those rules were in place, that the rent could be increased. Now, people would try to find other ways that they can do it, say by combining certain units or other things that were in the law that would provide a little bit more leniency. But the nuts and bolts of it was that if you had a rent stabilized apartment well below market rent, and I think this is really the key, is that certain buildings were more affected than others. But if you had a building that had well below market rent, and you wanted to increase that unit when it became vacant, you couldn't really do so. And if you were to do that, you're basically renting to a tenant at a number that's well below market, and presumably they would stay there forever. So what's kind of happened, a couple of things have happened as a result of that change in dynamic. One is that we found, at least in areas where the disconnect between the stabilized rent and the market rent is very high. So really Manhattan, for example, or prime parts of Brooklyn or Queens, if it's a market rent that is at, say, $3,000 or $4,000 a month, and the rent stabilized rent is $1,000 a month, landlords have been more inclined to not lease those apartments and leave them vacant than to get their $86 a month and put it back on the market. And the other thing we've seen on the sales side, so that's on the tenant side, is that we haven't really seen units, a lot of rent stabilized units come to market at these low rents. We've seen more of them be left vacant. Again, really in areas where the disconnect between the market rent and the stabilized rent is. On the sales side, and on just the building value side in general, it's just been very slow, even going into COVID. 2019 had the lowest sales volume of multifamily trades since 2011, actually. A few reasons for that. And as a result, the pricing has been really hard to kind of snuff out. Appraisers are struggling to find where values are because trades are so far in between. And really, because the laws have impacted buildings differently depending on the gap between their stabilized and their free market rent, every building has a different story to it. So a 5 cap in one building might really be a 4 cap in another. It's very choppy, kind of the data that's out there. So market participants are slow to act. Banks have been very cautious in their lending, and heading into the virus, it's been pretty slow on the sales side. As people adjust their values, and as some people get ready to see a bit of distress, if not through sales, people that refied and took out heavy loans on their property, or at the time what they thought were heavy loans, those loans will have to be reset when they come up on their refinance, and chances are the values will be adjusted, and that may result in some kind of shakeout in terms of distress. So covered a lot there. Anything you want me to really hone in on or focus on?
Absolutely. So you have certainly covered a lot, but the law has been in effect now for almost a year, right? Mm-hmm. We're coming up on July. And so you mentioned that there were landlords that are leaving the apartments empty versus renting them. Is there a lot of them? How long are they leaving them vacant? What are we seeing there?
So you mentioned earlier that there were, there's some pending litigation that's out there. So I think a lot of it, and even in the last couple of months, there have been, I went over the change in how to raise rent, but there's a whole lot of other things that the law included about, looking back on how units were deregulated, if they were done so legally, if there was fraud involved in certain laws, and look back periods and treble damages, and a whole slew of laws around that. Those laws just had some rulings that basically were in favor of landlords, and as a result have alleviated some of the pressure on banks scrutinizing units, and also on how people that are looking to buy buildings, do they need to look back 20 years at legal rent history, or do they only need to look back 5 or 6 years? There's a big difference administratively. So the reason I bring that up is that change from the courts, it really loosened things up on the buy side, on the banking side, how they could look at things. And until I think that some of these rules are being challenged, I think a lot of owners are inclined to see what kind of clarity comes out of the court rulings before they start making drastic moves about renting their units, about putting their properties on the market. Really, because in some ways the law was a little bit vague and a little bit heavy-handed. So even if you go to L&T attorneys, people that specialize in this stuff, on a few different matters within the law, you can get a few different opinions. So what people are waiting on is for some decisions to come out of the courts And then I think you'll start seeing, which can take, years to go through, as we all know. But I think until we have some clarity on a few more issues related to the law, people will be more inclined to leave their units vacant than put them on the market at severely discounted, at rents that are severely discounted to market.
And so I take it that has also affected sale.
Yes.
What have you been seeing in terms of sales? If you can't rent it and someone is asking, they want to know how many units are free market. They want to know what the rents were. They're looking at the prices. They're looking at, okay, what is the cap? What is the net? What do we have here? Mm-hmm. So how has that really affected sales? The leasing and the renting of these units, or lack thereof?
So sales they've just been slow. Like I said, they've been heading into COVID. It was the lowest volume since 2011. In terms of pricing, I would say that values dropped, and I know this is a big range, but it's because the law did what it did. The values dropped anywhere from 7.5% overnight to about 30, maybe even 35% overnight. But it's very building specific. It's not something that you can paint in a broad brush across the entire market. So seeing those types of figures, and there were a couple of big trades at the end of the year that reflected those numbers. Sales have been few and far between. Buyers really want to make sure that, that the numbers that they're getting are what they are. If there's a vacant, stabilized apartment, they're looking to see if there's a way that they can combine it with another unit or chop it up. And if they do that, there's ways that they can then raise the rent and stabilize it at that level. Rent-controlled units are somewhat more favorable than rent-stabilized units today, because the rule around rent-control units is that when a rent-controlled apartment leaves, you can basically renovate it, set it at market, and then, at least as they currently stand, and then stabilize that unit. But yeah, it's been very slow in terms of sales. Buyers are heavily scrutinizing DHCRs, as they were doing that beforehand, but now even many banks and many lenders have been scrutinizing them to a greater degree. And the diligence is higher, and the rents are questioned, and taking us into the current events now, people are looking both at the rents and also where the collections are with the COVID virus now upon us, where that's the big question of the day on top of the things that we were wrestling with previously.
And that's for sure. So how has the multifamily market responded to the COVID crisis?
So it was slow, and it's just gotten slower. There just haven't been trades. There have been some deals that were in contract that have fallen apart. Some others have stayed together. I'd say the ones that mostly stayed together were more so on the development side or on the commercial side, owner users of industrial properties, things like that. But what we were looking at, if we were looking at a reduction last year of 7 to 7.5 to call it 30%, I think with this you could tack on an additional 10% more or less compared to where we were previously. But the big question now is, and the same thing happened in 2008, 2009, is where are building collections? Where's the rental market going? On the question of collections, I've been somewhat surprised that the collections have held stronger than they have, based on the unemployment levels and everything that we're seeing. I think that's a testament to some of the government support that's been out there. Landlords and building managers that I speak to say that their collections are somewhere around 85 to 95%. So not that bad compared to last year, especially given the severity of the circumstances. And really right now, if we're marketing a building, we're looking at it every month, because we're still in the middle of this thing. So when we saw that most people paid their rent in April, and that followed up in May, and and it looks like June was also, you know, pretty positive. You know, the question, will July be the same? Will they continue to extend benefits? We're still answering that question, but for the most part, I'd say that collections have held, you know, with some exceptions, but not anything. You know, the sky isn't falling on that front, and rents also, to my surprise, they seem a little bit sticky in buildings that we're marketing. We're not seeing drastic declines in rents yet. I think that's going to be a longer process to play out as we see, you know, the spring and summer units that are vacant stay out there a little bit longer. I think there's going to be downward pressure on rents for a while, both from a supply perspective and from you know, just a broader economic perspective. But I remember even going back to you know, 08, 09, when I was living in the city, and I thought my rent would go down by, I was in real estate, I was younger then, but I thought my rent would go down by, you know, 30, 40%. And, you know, it went down, call it 10 to 20%, more or less, across the board, you know? So I think that rents will relax. I think that we need to figure out, you know, where the tenancy picture is going to be long-term here in the city. Ultimately, I think the city will bounce back from this, because I'm a New Yorker. I'm optimistic about its trajectory. But also, I think a lot of the people that I speak to see this, you know, similar to the trends that they saw after 9/11 in terms of tenants leaving and coming back a couple of years later. You know, it's a global city. Hong Kong went through something similar with SARS I believe it's about a decade ago, and they came back stronger and with a lot of public health practices in place that insulated them somewhat from COVID. So my hope is that you know, we get through this, we change what we got to change here around the city, and within a couple of years we're you know, we're back to you know, growing as we should be here in New York.
Okay, that's great. So what factors are you paying attention to as the city reopens? We entered phase 1 yesterday. So what are you paying attention as we reopen the city?
So like I just said, you know, we're going to keep an eye on collections. I mean, definitely we're going to keep an eye we're keeping an eye on the rental market, checking in with people every month to see how they're doing, checking in with rental brokers to see how optimistic they are. Clearly, we're paying very close attention to any federal assistance that'll be coming to New York City, to New York State. That's just huge for all the services and that the city needs for our mass transit. And yeah, I mean, that's really it. I mean, I'd say, you know, the federal government now needs to step up and back up New York. We do a lot for this country, and our economy is the size of a small or even a large country's, the New York metropolitan area. So, you know, we're paying attention to those factors and the incomes and you know, and tenant responses. You know, I could definitely see out of this, and I'm curious your thoughts as well, how you see tenants adapting to the leasing environment. You know, our sharing going to be, you know, less looked upon? Are people going to start changing up their unit mixes in buildings, going with more studios and smaller units so people can live individually instead of, you know, shares? You know, we're keeping an eye also on how the student housing is going to be affected. We were pleased to see that NYU plans on opening up this fall, and I know a few owners that usually, you know, lease their units to NYU students year after year. So if that population wasn't coming in, you know, first time in a long time that they would have to answer questions like that. So a lot of this is answering questions that we usually kind of overlook, you know. So figuring out those questions and trying to come up with answers to them is part of the game right now, whether it's with leasing, whether it's collections, whether it's unit shares. You know, the student aspect that I mentioned, that goes for, you know, that goes for Brooklyn Law, that goes for Columbia, that goes for CUNY. How those schools get back on their feet, I think, is something that we'll all be paying attention to in the fall, when hopefully we're not dealing with another resurgence of this.
I totally agree with you. That is definitely something that we will be dealing with. And I've heard of, I was speaking, we had a property manager and a developer last week on our program. And, she was talking about having a property in a student area that is heavily a student population, and parents are reaching out to secure those, although they're not sure, they will have, whether or not it will be remote or they'll have in-person classes. They're reaching out, and one person wanted to secure the property and pay a year up front just because. So it is possible that the dorm and sharing, that might be affected. There are probably going to be parents who want to say, you know what, I'd rather pay more than to have several of you being in the same apartment at the same time. And that's a part of student life, living together with others, but we may see a change or even people being more selective of who their roommates will be. So that's something that we most certainly will have to watch to see what will occur. But equally, I sit on Council for the Profession for Law, and there've been talks like there's schools that have not decided as yet whether or not these law schools will be open for in-person classes in the fall. This is still an ongoing discussion. So I think schools are making plans, and they're making alternative plans, and to say what they will do. And if they are not on campus and it's remote, I believe the market will definitely be affected.
Yeah, no, it's crazy. I'm an NYU grad, and I stayed in the dorms at the time. And, it was a 1-bedroom where 4 people lived in it. With beds on each, like that was the way. That's how you do it. So
you do it, yeah.
If I was living, back then with a virus like today, would I have done that? I mean, I knew most of the people. There was 1 or 2 that I didn't know in there, but it was it flips things like that on its head. Things we take for granted.
For sure. So tell me, you have seen previous downturns. How does this current real estate environment compare to those downturns, both in terms of similarities or differences? Mm-hmm. What is it? How do
a couple things. So I think the biggest difference to start with first is that the market today is very well capitalized. When the downturn hit in 2009, not only were investors kind of scrambling to see where to buy or what to sell, everyone was kind of in shock for a while, but the banking system was also teetering, and it was really left to local community banks to step in and lend. And there wasn't a whole lot of places to turn to for buyers and for lending. It was really down to who had cash, and cash was very scarce. It was a real scramble in that respect. Today, and even this predates even COVID. People knew that there would be a shakeout from the change in the rent stabilization laws. So there's been a lot of money, as they say, the cliche, on the sidelines for a year and a half now, and they're checking in on a fairly regular basis to see if there are buying opportunities at real discounts, and but also making the point that they're not looking for severe cuts in price from where they were previously, not looking for 50 or 40% off, but they're looking for a fair discount relative to market value at peak, and they want to know when those numbers start showing up. And so far they haven't, and that's why we've kind of seen few sales take place. I think the other thing that is different this time around is that there should be some less distressed sales on the multifamily side, because the financial reforms that were done under the Obama administration really made it so that investors in multifamily had to put a lot more equity into the deals in this cycle than in the previous cycle. The banks took a lot less risk in terms of what they loaned out and how they valued the properties. So, our banking system is far more secure today than it was previously. And again, I think that kind of, if there's going to be a drop in values, it won't be as severe as the previous downturn. If it is, it'll be more so because of the rent regulations and how that continues to unfold than it is, financial distress in the market or anything like that. So, and I think in terms of, differences also kind of what we were just talking about in terms of, having to reconsider things that you've taken as given economically for a long time in the city, that's also a little bit different at the same time. Where's the restaurant industry going to go out of this? How quickly are the jobs going to come back? How quickly are people going to get on mass transit? So this downturn, in some respects, is economically just it's more far-reaching. I also think that if we turn around and cure the virus tomorrow or in a few months, the snapback could be much quicker than the 09 downturn, which took many years. I think this could come back hopefully in half the time, but we're really contingent on a virus in this case. So that's a variable that we need to figure out. But it's pretty. We're getting through it, and the capital is there. The capital wants to invest in the city. I think that long term, this city will continue to have a housing crisis unless we really start building a lot more. And when I say building a lot more, I mean building a lot more with affordable, not just building all free market, but building in general. Without building, I think that we're going to, continue to see rents rise because there's a lack of supply relative to the demand. Hopefully out of this, with interest rates being as low as they are right now, public and private investment will take place to take advantage of those low interest rates and make our city come back stronger. Kind of just like as we did after 9/11, we rebuilt all of Lower Manhattan after that, and now we can look to do that in other parts of Manhattan and other parts of the city, and this time add some real permanent affordable housing to it. That is there for the long term.
Right. So if I hear you correct, Michael, you're saying there is capital in the market. There's capital out there in the sideline, and they're ready to invest. They're just looking for the right opportunity, and you believe they will be invested in New York once again as soon as we have the virus under control.
I think so. The one caveat to that is political uncertainty, and what I mean by that is people want to regulate housing. They're going to do that. What keeps slowing things down is the rules keep changing. So there was, they changed the rules last year, and then there was, even going into this year, another reason that things were slow going into COVID was that there was going to be another round of rent regulation that was potentially going to be released in June, but it was a big question mark as to what that would entail and how much more were they going to strengthen things? How much more litigious were things going to get? So we really need, I think, some clarity on the regulatory front, not just in the short term, but in the long term, about how the city, how the state is going to engage the real estate community, ownership, building management. And we need, a longer term plan that, can't throw a wrench in the wheel midway through just a rule change that just happened. So, for example, when they changed the 421A tax benefit to the Affordable NY program, that set the rules for 5 years. And then developers and landowners can price their things based on those rules and not expect any changes material changes anyway, for that period of time. That kind of security in terms of timeline didn't accompany the 2019 rule changes. So if something's going to keep things slow, again, on the multifamily side, development's a little bit different, but if something's going to keep things slow on that front, it would be uncertainty in the regulatory environment. Once people know the rules and they know how long they're going to be around, the market will reset pricing, people will buy, and things will adjust. Right now, we're still in that muddled field, regulatory-wise and court-wise, as you mentioned earlier, where it's hard for buyers and sellers to make those decisions clearly.
Okay, I see. Thanks. Just as a reminder for those who are on the webinar, you can continue to put any questions that you have in the Q&A. We're going to be wrapping up shortly, but if you have any questions before we wrap up, please put them in the Q&A. Michael, one more question. So in terms of, let's look at short-term and long-term impact of COVID on the New York City real estate market. Any thoughts on that?
Sure. Short term, I think it's going to be slow. I think we're in a bit of a jam right now, and I'm optimistic about. I'm seeing more and more good news about the potential for a vaccine, and they seem to be making some breakthroughs in treatments to get people out of hospitals faster. It's great to see how the city as a whole. I live in Brooklyn right now, and everyone downstairs is wearing a mask, and everyone's very respectful of each other's space. So it's great to see how, as a city, we've all kind of come around to the same rules of how we're going to engage each other. So I think that's encouraging, and it speaks to the character of New York. Short term though, we have to see how these how the stimulus continues or takes away, longer term, I think my hope is that we do something like I said earlier that Hong Kong did, and we strengthen. Maybe we change around some of our building regulations. Maybe we upgrade things to accommodate changes in public health and adapt ourselves for a future where this may pop up again in one way, shape, or form. But we need, New York has a history of adapting to the times and toughening things out. So I don't, that's in our DNA, and I don't see that changing anytime soon. We'll bounce back from this like we bounced back from every other catastrophe the world's tried to throw our way. And I think we'll continue to be we're a global city. We're not, the rest of the country has some great cities, and I love them. But when you think New York, you think on the level of London, Hong Kong, global capitals of business and arts and culture, and a virus isn't gonna take that away. We're gonna hit some stumbling blocks, and I think getting back on the mass transit's gonna take a little bit for people to get back in the groove on that. But we'll come back from this. It just may take a little bit of time, and we also are pretty impatient. So it may not go as fast as we'd like, but we'll grumble about it, get over it, and get back to work.
Okay. Well, to remind you, we are speaking today with Michael Tortorisi, and he is the Executive Vice President and founding member of Ariel Properties Advisors. And Michael, before you go, any final thoughts that you want to share with our viewers today?
I think no. Just feel free to reach out if you ever need any insights on the investment world. And I thank you, Kaylin, for inviting me and being such a gracious host. And I look forward to working with you in the future. Really appreciate this.
Sounds great. But just let us know, if you can just let everyone know what the best contact number and email is for you, that would be great as well.
Sure. That's mtortorici@arielpa.com. That's M as in Mary, Tortorici at Ariel, Ariel, P as in Peter, A as in Apple.com. And phone number you could reach me at is 212-257-1813. That's my direct line. Goes right to me.
Okay, thank you. I don't see any additional questions in the chat. So I just want to say a big thank you once again, Michael. You have shared a lot with us. Greatly appreciate you joining today. And for everyone who has joined us on the webinar or who have joined us live on Facebook, thank you. Until our next edition of Real Estate Roundtable, goodbye. I'll see you next Tuesday. Take care.
Thank you.
Thanks.